Last year, which was a year in which commercial property activity increased quite considerably, only £28 billion worth of commercial investment property changed hands. That's 3.5% of the total market. When you look at the turnover in the listed stock market, 146% of the listed stock market turned over. It's a mammoth difference. And then when you look at the gilts market, which is the most liquid market of all, the turnover was 517% of the value of the market. And even at its peak in the bubble years, the commercial property market only turned over 9.76% of the total value of the market. And you have to bear that in mind whenever you buy a commercial investment property. We probably, the UK market is probably one of the most liquid markets in the world, but it is an incredibly illiquid market. And the reason it's important to bear that in mind is that exiting property, which is when you obviously crystallize your capital gain, may not be possible in the way that one might have hoped when you bought the property in the first place. It may not be possible to do it. So the lack of liquidity is something that should exercise your mind every time you buy a commercial investment property. And that has to be addressed in any investment strategy. That's the graph, incidentally, if you want a graphical illustration of what I've just been talking about. That's the that's gilts, massive turnover. It's down since the bubble years, but it's still massive. That's the stock market, again down, but only marginally so. And that's property, flatlining at virtually zero. And as I said, we probably operate in the UK in one of the most liquid property markets in the world. Addressing illiquidity, there are a number of ways people have come up with to address illiquidity, and the first and most obvious is public companies. Property is illiquid. You can put it in a public company, you can do whatever you like with it, it will remain illiquid. And this share price graph, which is plotted, the share price is the purple bit of British Land, and it goes back to 87, so pre at least my first property boom, all the way through to current day. British Land share price is the purple bit. The red squares are British Land's net asset value at any point in time. And net asset value is the value, effectively the net value of the properties that British Land own. And as you can see, a cursory glance at the graph will tell you that, actually with the exception of a few points in history, the share price of British Land has never really given you an opportunity to exit at the net value of the properties it owns. So the notional liquidity that comes with owning a publicly traded share actually comes at a massive price. And the price that you pay for that liquidity is the difference between that red square and the price at any point in time. So the notional liquidity cannot, in my view, be made up by owning shares in a public company. The other notional way to give effect to liquidity is to set up an open-ended structure. And the idea behind an open-ended structure is that you can trade your units in whenever you like. But there are massive drawbacks with open-ended structures. At the very least, in order to provide the liquidity that open-ended funds promise, they have to hold cash. And holding cash is a very expensive exercise because it yields particularly at the moment, it yields nothing. So your return that you earn on your property is materially reduced by the cash that they hold. And then to really rub salt into your wounds, when you want to sell, which is generally when the market looks like it's going to tank, there'll be some fine print in the clauses that govern the unit trust or the open-ended fund that says, actually, you can't sell. We're going to close the fund. And a lot of you would have experienced that during the credit crunch. You would have been prohibited from selling. There's only one way, in my view, there's only one honest, true way to have liquidity in commercial property. And that is to make sure that the income stream that you're buying is high. You want a high yield when you buy the property. And the high yield creates its own liquidity. You're getting your dividend every year. If the property is leveraged, and what I mean by that is if you've borrowed money to buy the property and you've therefore got a mortgage on it, the need for high income is even greater because You've got to make your income, you've got to pay your interest on the loan, you've then got to pay tax, and then after you've paid your tax, you've got to then repay, presumably, an amount of capital. So you must have what we call in the industry a yield gap between the interest rate that you pay on the mortgage and the price at which, the yield on which you buy the property. You must have that yield gap. Absolutely vital. The other thing I want to talk about, which is vital in one's assessment of an investment strategy, is the cost of trading property. It used to be very cheap, and the Labour government increased stamp duty on property in successive steps, so that now if you're buying a commercial investment property of any size, you're actually having to pay 5.8% on top of the price of the property to buy it. That compares to about 0.75% when you want to buy a share on the stock market. And why is that relevant? Well, it's relevant because just to break even, you've got to make a capital gain of 6%. Just to break even, you've got to make a capital gain of 6%. If you borrow money against your property and you've had to pay arrangement fees to a bank and valuation fees and so on and so forth, your costs are even higher. So you might need to make somewhere near 8% capital gain just to break even. And if you bought the property, and a typical sort of property yield at the moment might be 6%, if you bought the property on a 6% yield and your aim in life was to hold it for 5 years, and you sold it at the same price that you bought it for, you will actually earn a yield of 4.8%. You won't earn a yield, the notional yield of 6% that you paid for it, you will earn 4.8%. You have to make a capital gain to preserve your yield. And the other thing one needs to remember is that long-dated gilts, which is the risk-free rate of return that we all talk about when we measure risk, actually yield 4.4% at the moment. So if you're buying a property on a 6% yield and you don't make any capital gain, you'll be lucky to beat the risk-free rate of return on gilts. So you've got to be very careful when you buy properties at yields of 6% or below. What caused the credit crunch? Well, undoubtedly, in my view, no matter how much Mervyn King might now protest otherwise, it is entirely driven by the very low interest rates that we've had in this country over the last 13, 14 years. The first cut in interest rates, throughout the 90s incidentally, we haven't plotted 90s here, but throughout the 90s, you bought property on a sort of 9% yield and you borrowed at about 6 or 7%. And then something changed after the LTCM crisis. You might remember long-term capital management. When they went bust, Alan Greenspan promised that he wouldn't allow systemic risk to enter the economy again or to enter the banking system again. Actually, that's exactly what they went on to do. Systemic risk was something they had absolutely no attention to whatsoever. Interest rates were cut in the UK, they were cut in the States. Minor blip up in interest rates. And then another cut when we had the dot-com bubble. And these are probably the worst interest rate cuts in the history of the Bank of England in my working life, because they happen not for economic reasons, they happen for political reasons, which with the benefit of hindsight actually didn't have any material effect on the economy. So 9/11 happened, everyone was fearful of asset prices crashing, they cut interest rates. The Gulf War happened, everyone was fearful of economies stalling, they didn't stall, and they cut interest rates. And of course, every time you cut interest rates, what you're doing, I think of it like this, I think of the economy as an elastic band, and I think of interest rates as a force that you apply on the elastic band. And every time you cut interest rates, you're pulling the elastic band wider, you're widening the economy, you're enticing people to borrow. People are generally fairly two-dimensional. If interest rate costs are low, they'll borrow more money. And every time you borrow more money, you're pulling on that rubber band. And eventually you get to a point where the rubber band becomes elastic. It can't, inelastic. It can't go any further. You've gone too far with your stimulus. I remember throughout this period, everyone was talking about the potential threat of deflation. Nothing could be further from the truth. What we were experiencing through the early 2000s was what I call the China effect. China was producing goods at massively cheap prices. We were buying them. America was buying them hand over fist. It kept the cost of our purchases low. It gave us the impression that inflation was low. And Tony Blair is guilty of a lot of things. And one of the things he is guilty of, at least Gordon Brown was guilty of in conjunction with Eddie George, was the shift from RPI to CPI. The target that was set for the Bank of England was 2%. By moving the yardstick from RPI to CPI, the government disingenuously allowed the Bank of England to be meeting its targets. The Bank of England felt no compunction of any serious note to raise interest rates through what was regarded as this potentially deflationary environment. And all the while, RPI was roaring away. Asset prices were increasing dramatically. And that's where the bubble was created. The next reason, the next major reason for the cause of the credit crunch is the development of the commercial mortgage-backed securities market, which was a brand new non-banking market. It had never existed before. It's unlikely to exist in the form that it did exist in the bubble years again. And this, in my view, was driven again by very low interest rates. It allowed banks to entice people to buy all sorts of rubbish, cross-collateralized mortgages, apparently with low risk, tranched up and sold as low risk. The subprime credit crunch in the US is a much better example of the way the banks perpetrated this particular product, perpetration being an apt use of the word, I think. And 50 billion of this stuff was pumped out in the UK alone. And if you put that into the context of last year's turnover, that's 2 years' worth of commercial property turnover in 2 or 3 years of commercial-backed mortgage securities. I put fund managers down as more responsible for the credit crunch than I do bankers. If this was a presentation on residential property, I'd put bankers higher up the scale, because you can forgive the average man on the street for being tempted into borrowing lots of money. But you know, people like me are actually paid to call this thing right, to be honest in our interpretation of the market. And I remember talking to a lot of fund managers, and when I say fund managers, incidentally, I mean directors of public companies and all the rest of it, back in 06, 07, who kept saying, oh, the London market's fine, it's absolutely fine, you know, capital values are going to go on going up. There's this belief that capital values will keep going up. And that belief allowed them to create fantastic IRR calculations. And what happened in the boom years was that fund managers started relying on IRR. They couldn't use ROE because prices had gone up so much, yields had dropped so much, they couldn't possibly honestly say to anyone, we're going to make a stonking ROE, because the ROEs were rubbish. But what they could pretend was that the exit price is going to be fantastic, because look at how the market's moving. And because of the exit price, we're going to make loads of money on this investment. And so I hold fund managers squarely responsible ahead of irresponsible lending. But there was an incredible amount of irresponsible lending. And I didn't really appreciate how much irresponsible lending there was until the credit crunch hit home. Now, I think it would have taken a very prescient individual to predict the extent and severity of the credit crunch. But the credit crunch in commercial investment property in our market was very predictable. It was easy to see. If you believe that property is illiquid, if you believe in the yield gap, if you believe you've got to have these yardsticks in order to be investing safely, you would have predicted the property credit crunch. In about September, October 04, we had, for the first time in my life, the inversion of yields. The yield gap disappeared. Now, it looks like there's a yield gap there between prime property and interest rates, and between second property and interest rates. There isn't. In fact, the yield gap's disappeared, because on top of your base rate, you've got to pay the bank a margin. And when you add your margin in, the yield gaps disappeared, and it just got worse. You know, it got horrendous, actually, because there was absolutely nothing there. In order to justify buying a property after 04, in other words, in 05 or 06, you had to believe in capital gain, because the yield gap had gone. You had to believe in capital gain. There's been a tremendous rush into what we call prime or core property. And this is the graph of, the purple line is yields, so massive increase in value of properties there, massive reduction as you go through the deflating of the bubble. And of course, on top of that, you've got rents moving too. It's not just yields that move. As yields move out, rents are dropping. So you've got to multiply one with the other. So those rents are dropping, yields are going up. You are being crucified. This is prime property. This is notionally what every media correspondence articles that I've been reading claim to be safe at the moment. Everyone's heading into prime property. Jones Lang LaSalle announced yesterday that there's £50 billion chasing UK property at the moment. 40 billion is targeting West End offices and city offices. 40 billion. So yields are back to boom levels, but yields are back to bubble levels. I suspect prime yields are going to go on dropping, given that 40 billion pounds is chasing prime property. I suspect they'll go on dropping. I suspect prime property prices will go on rising for a while. But do you want to take the risk of buying that and being able to exit before the next collapse? And what's particularly worrying for me is we blew up the bank's capital in the credit crunch. This is all, or principally all of this, is unleveraged capital. This is equity. This is people buying with their own cash. So we blew up the bank's capital, and now we're having a go with our own capital. So where is the opportunity? A lot of people won't agree with me, but the opportunity actually is in secondary property. Everyone's rushed to prime property. That's the prime property growth. It looks benign again. Don't be fooled. That's a massive collapse in values. Massive collapse in values in secondary property values. But because no one's buying it, it's still up there. And not all secondary property is bad. There are lots of pressures on the secondary property market, which I'll come to in a second. But the opportunity, in my view, the real opportunity is in this sector. You've got to tread very, very carefully. You've got to tread carefully because there are a lot of pressures on that part of the market. But that's where the opportunity is. It's all about income, in my view. You know, investing in property, it's all about income. You're not getting income on prime property. The yields are too low. You can only really get that income by going off prime slightly. The real problem with buying property in this country at the moment is that we are in a very weak economy. You can only really be confident about rent if there's demand for space. And we are in a weak economy. We will continue to be in a weak economy for some time with austerity kicking in and so on. And so income is under pressure, so tread very carefully. The CMBS that I talked about, the £50 billion worth of extra money that was pumped into the UK market in 06-07, that is all now unwinding. And unlike the banks, the owners of CMBS debt can't roll the debt. They've got no mechanism by which to roll the debt. When it comes up for maturity, they might have a time in which to exit their position. They have to sell the property. So we've got at least £50 billion worth of property, or property secured on £50 billion worth of debt coming to the market over the next few years. That is going to suppress prices. As the bankers amongst us will note, Basel III, which is a belated response to reining in banks, requires that by 2019 higher capital adequacy ratios are adopted by banks. That's going to constrain the ability for banks to lend. That's going to bring pressure on commercial property. And inflation, having discussed the appalling method by which we've reduced interest rates in this country, you know, there is a risk now. I'm going to do a 180-degree flip. Raising interest rates now materially could be hugely dangerous for us. We have expanded the economy to the end of its elasticity. There's no more elasticity, in my view, in the economy. We start raising rates now, we could see a real collapse. And I think Mervyn King is aware of that. But if inflation continues to stay up and increases, or certainly gets well set in, you could see interest rates go up, and that could be a massive blow for the commercial investment property. And I'm just going to tell you about one deal that we did recently. This is a property in Coventry we bought. As you can see, it's let to Poundland. It's in the marketplace in Coventry, so it can be considered as a prime property, but in a secondary city. When it last traded, which was in '04, note the date, because '04 is before the bubble. It was let to Woolworths at £12 a square foot, and it sold at £11.8 million on a yield of 5.1%. I can forgive the buyer for relying on the Woolworths covenant. You know, that's a fair bet. Back in '04, no one could be faulted for thinking Woolworths was a good covenant. It eventually went bust, as I'm sure you know, but Woolworths back in '04 was a good covenant. What I can't forgive him for is that 5.1%. We bought this property last autumn. Woolworths went bust. It was let to Poundland at £9.96 on a new 15-year lease with a 10-year break starting in '09. '09 leases are great. If you can buy property let in 2009, it's great, because it basically means the tenant took the landlord to the cleaners. So you've got a very low rent versus the 25% reduction in rent, and we paid £6.3 million for it. Massive, and we a 7.73% yield. Massive destruction in value between when it last rented, and that is before the bubble. I believe this property was valued in 2007 at £15.5 million. So he would have felt extremely clever in 2007, having bought it for 11.8. But actually, he didn't exit. And it won't surprise you to know that we bought this property from the receiver.